exercise at the same time, keep my eyes on the business. So today people have been asking me, I still love listening coming in about fintech, my partners, friends. And I thought I should talk about fintech and the common mistake a lot of people are making. Initially, when you're starting a fintech company, it's either you are paying money out, taking money, or giving money. Now, there are things that you need to understand that will help you not to get into trouble. The first thing you need to understand that the fintech industry is highly regulated. So you need to understand the fintech framework, the regulatory framework. What does regulatory CBN, SEC, what are they saying regarding to what you're trying to do about lending, about taking deposit, about paying money. So first of all, you need to understand what is the regulatory authority saying about what you're trying to do. So regulatory framework. Secondly, you need to understand the financial framework. You want to give money, you want to earn something. Maybe you want to give capital, you want to get interest, basically. Then you need to also understand the operational framework. Okay, how does it operate? When things go wrong, how do you recover your money? And how do you protect yourself against that? Then you need to also understand the legal framework. And how do you represent this in a legal document that put you in a safe point? What you need to realize is that because it's a sensitive environment, it is regulated. So if you are taking deposit to invest on behalf of people, you need to think about having a SEC license. If you're also taking money as deposits and giving loan. So there are various reasons why you have different operation and there are different regulatory licenses that fit into different case studies. But one thing is critical. You're just starting a new company, you want to test run your product. You don't have a license here, you don't want to invest your money in licensing, you don't want to invest your money in a lot of things, but you want to test the operation. You can do that. Let's look at it from the regulatory point of view. The regulator does not want you to invest in any company, any interest without a regulatory authority. The regulator does not want you to take people's money in pool and begin to invest it on their behalf without a license. But there's a little way to go around this, okay? The regulatory authority cannot tell you how to invest your money. So if you want to go into lending and all that, you can decide to invest into company through investing money in their company, okay? Now having a profit sharing. That is totally different. You can use that to start your business by signing an agreement. It basically says that you are working together with this company to provide funds for this purpose, and at the end of the day, you are getting profit sharing of this amount. That way, it helps you. You're not talking about capital, you're not talking about interest. Again, the other problem is if you are on the wrong side of the regulatory authority. When you have anything going wrong, you might find it difficult to recover your money and the regulator can be after you and you lose all your investment. So you need to understand what is the regulatory requirement and how authoritative way can you start this business. You can start by investing in piecemeal into companies and share profit and watch it and see if it has grown to a certain level. You can decide to say, okay, I really need a license. Another thing you need to look at is that in the financial part of it, as you're giving the money out, you might say, oh, I want to invest in this company for 2 weeks, 1 month, and I want to share profit. And this is, you can put, this is the cycle of the transaction you want to operate, maybe 30 days, 15 days, and all that. You can actually invest in a company for 1 week. That's the choice. Nobody can tell you how long to invest in a company. You can start to invest in a company and share profit in a week. And there could be penalty, maybe saying that when there's a delay, but you should avoid using some technical things that put you in the side of the law or on the wrong side of the law by maybe interest, maybe capital, all the things terminology that make it look as if you are giving out loan. But what you're doing now is actually not giving out loan, but you're investing in companies and sharing profit. So get it right. Okay. Now, in the operational model, you need to think about how do I protect this. Maybe you can say you want to get some instrument as backup for the operation you want to do, and this could be it might be an instrument, it might be a domiciliation saying that we're gonna have a particular account where we put money where probably you are joint venture or joint signing or whatever. All these things will be implemented to basically have a way to recover your money because if you're giving money without thinking about security part of it, then it's like throwing your money out. So you need to look at the operational part of it. Or how do I give this money out? What are these things going on? How do I recover this money? Okay, if I'm going to recover this money, do I need a postdated check? Do I need some kind of domiciliation agreement? So all of this can come in without actually putting you on the wrong side of the road. Okay? So don't forget, you can start by investing in company profit sharing. You can recover by other instruments that maybe postdated check and all of that. But you see a lot of companies, they want to go into startup, they draw their agreement, and they need to put out all those elements that put them on the side of law, and the law can come after them. Another thing is that when you're drafting this agreement, you might have prepared in your mind that you want to do invest in the company and do profit sharing. But the contract has to have the right terminology describing. So if you're putting money in the company, it has to be stated as an investment, okay, or an operational fund. Don't represent it as a capital because immediately you represent it as a capital, it means you're already going into lending. Okay? So you represent it as either you are putting money for operation of the joint agreement that have been created or special purpose vehicle or whatever you want to call it. And you guys agree on some level of profit sharing. Then for you to stand and see, I have invested this capital, it's going to put it in the arm of law and it's very, very dangerous. So the agreement should purely some kind of agreement, maybe a joint venture agreement, maybe a operational agreement, whatever thing you want to call it. But you clearly find that you're working on a certain project together. He is responsible to provide funds, and when you make this money, you are going to share profit like this. And these are the required protection you want for this transaction as the one bringing the money. You can ask for all of that. Okay? And you can also agree on responsibility from the one that owns the business, from saying that you want the transaction cycle to be this, and if the transaction cycle is not this, these are the required penalty. You don't need to say default. Those items are going to put you into trouble. You don't need to say default charge. You're not a bank that you should charge anybody default charge. We can charge a penalty for delay, not meeting up for certain targets. Oh, we're not meeting this target. These are penalty and all of that. It's very, very funny that it's just between thin line to go against the law and to stay within the law. Very thin line. But you need to understand what are the regulatory framework, what are the operational framework, what are the financial framework. If you add all of these, that's why it's compulsory for every startup to have a bit knowledge about statutory development of every operation and a bit knowledge about legal related to operation, financial activities related to operation, regulatory activities related to operation. Because if you do, because I see it every time when you see company going into signing an agreement, and if you look at the agreement, it's technically representing them as a bank, which they are not, or representing as a lending platform. So these are the other thing that people can also do is that if you're doing an online payment, you actually go for maybe a state license that gives you ability to operate maybe online and locally within that operation. But they also have a disadvantage because when you depending on the kind of fintech you're doing, so fintech you might need to open account for people, you might need to take money from people, you might need to also have a designated account and create a lot of accounts. But when you're doing that kind of state license, it's limiting to the kind of operation you can create. Okay, so the first thing for me is to look for a way to have a more sharing arrangement and profit sharing, depending on the time you have validated your product that is working, and get to a point where you are getting a product market fit, then go after the license because sometimes the licenses are very expensive to get and all of that. You can operate from investing in other people's business, profit sharing, build traction, build relationship, build experience, and build all of this. And over time, you can have the key to say, okay, I want to I want to take this money uh, as an equity or debt to go for license and all of that, their capital interest and all that. That's one way. Another way some people also do is to come with, to partner with people who have license to create to jointly create product and leverage it and their license to provide that product. Depending on the time, they can now apply their own license. Okay. But the funny thing about this is that sometimes when you go to somebody who have the license, they tend to behave like they are the alpha and omega and makes the startup complex, make things complex for the startup that is trying to leverage on such license. Whereas if you have somebody that is reasonable and understand the fact that you are building a great company, you're trying to solve society problem, and understand the innovation you're trying to create, you guys can come to a reasonable agreement to help you see how they can also benefit. You can do profit sharing with them while you leverage the license to, because it's very, very important to test your product, to test the water before investing blindly into things. You need to test the water. So if the person agrees to use, there's some kind of an exchange of value, maybe sharing, or maybe some share or whatever, or maybe some profit sharing, negotiating reasonably to help you create that product market fit to a point where you are sure that you have the right product. Because sometimes we have all these crazy ideas in our mind, we are not too sure whether it's going to work and all of that. You need to test run this product over and over, begin to take top party money, and begin to expose people to a bigger risk. And expose yourself to a bigger risk. And you fail, and sometimes failure takes some time to recover from it. So all of this will be prevented by taking this either of these steps. Is that you start by strategically investing in another company and sharing profit, or by leveraging with somebody who already has a license and just run your product before you begin to go into a lot of investment opportunity that will drive your company to the next level. I see this happen every day. Every day I review a lot of agreements from startup within the ecosystem and outside the ecosystem. That when I look at it, I say, but you don't have right to do what you're doing. You don't have right to put this kind of thing in your document. Why not? So that is why it's very important. I also realized something, that you need a startup lawyer, somebody who understands a startup, to help you draw out an agreement. I was talking to a colleague of mine, and he was saying that he had a lawyer that's going to drive this agreement. I said, no problem. But if you want to get a lawyer that does not understand what startup is all about, you need to explain to them what you are trying to achieve. Okay? I need to be able to explain to them to an extent that, come, I want to do this, and I don't have A, B, C, D. How do I go around it? There's a lot of ways to go around this, but you need to get someone who understands what you're trying to do from the legal point of view, operational point of view, financial point of view, understand that you're trying to build a startup. And right now, you just need to test run the process before you begin to incur a lot of costs. So if you understand, and because the legal part is very important, because every other thing that you do leverages on the legal documents. Okay, even when the regulator want to come around you, what they will check is the documents to check whether you are breaking the law or you are going outside your own space and all of that. You still need the point of control. So the legal part is very, very, very key. So you need to understand, to get a lawyer that understands that. And that's why most time when I'm working with my lawyer, I need to explain to them from different angles, so that when they are breaking out the legal, interpreting what I want to do in the legal term, they can protect me from the understanding of my position. So it's not the fact that you can say, oh, somebody is a corporate lawyer, come and grab it. It doesn't work that way. Because the truth is that for every fintech, they have different approach. And they're going to have a different form of agreement to make sure they are safe. So I thank you guys all every time. I always want to come here to share my knowledge and tell you about my experience, talk about the experience I have, and answer my audience when they ask a lot of questions. Because that's what I'm here for, is to see how we can help more startups to grow fast. So now we're talking about fintech, so I hope I've really helped someone today to build a great fintech. So let me play my laptop before I leave. Thank you, guys.